Just when you thought things could not get any worse from the massive drop that we got on Friday, things have started to pick up again, and it looks like the start of the week isn't going to be any better. In fact, we're seeing Nvidia below $90, down 6% in the pre-market. We're seeing some very large drops to others in the Mag 7 as well. Tesla down 7, even Palantir, which was very strong, that was not too long ago, above $100, now sitting at 8, and again SoFi Technologies around the $9 mark, down nearly double digits, and we're just seeing this trend continue across many stocks that we actually believe are very high quality. And whilst the fear and greed still sits at for extreme fear, given the news we are seeing in the pre-market, we do believe this could go even further, meaning uncertainty is sitting at some extremely high levels that we haven't seen in such a long time. And it isn't just the US market, in fact we're seeing global markets down, and down significantly they are. For example, if we take a look at the German market, it opened down around 9% earlier today. The London FTSE market down around 5%, and in fact the Hong Kong market was down around 13%, which is their worst single day trading since 1997, something we do believe we could see across the market, especially when the US does open. Now lots of bankers and hedge fund managers are starting to get very worried. They ultimately believe the markets could go even lower than what we could imagine, and this is something we do need to take note of, especially if we are an investor, because we have to remember this drop we are seeing in the market, unlike COVID, isn't a black swan event. This is unfortunately self-inflicted and did arrive when Donald Trump showed that famous board running through all of the reciprocal tariffs, something now traders are calling the chart of death. So what is Donald Trump's response to this massive stock market drop we're getting? He was put this question just yesterday, and his response was that sometimes you have to take the medicine in order to fix things, so he isn't backing down from these tariffs, and some investors may actually question whether he means medicine or poison given how far their portfolios are dropping. He's also spun this in a positive way now, saying that all prices are down, interest rates are down, the slow moving Fed should start to cut rates, and ultimately he's saying there is no inflation in the US anymore, and he's actually pointing this market crash to China. He's saying the biggest abuser of all of them is in fact China, whose markets are crashing and did just raise their tariffs by 34%. So if you're someone in the camp who believes we are going to get negotiations very soon, we're going to see things start to settle, based on the information that is coming out from the president, it doesn't look like it is coming any day soon. And no one could have really seen this coming. Even Bank of America a few months ago, who believed we were in for a 40% drop, they ultimately put this into the fact that growth stocks are in a bubble. But what we're seeing right now is red right across the board. It doesn't matter what company you own, it doesn't matter what industry your stocks are in, but we are seeing a very large crash across the whole stock market, and that is also globally. And if you wanted to know the extent of this, in fact, just the last 2 days, Thursday and Friday, $5 trillion was wiped off the US stock market, and that is a record 2-day decline for any benchmark going all the way back to the 1950s, so this is definitely something serious. Now when we look to Tom Lee, as we have done in past episodes, he's been very bullish. He's saying that ultimately he believes the market is going to have a large V-shaped recovery, and that Tesla would be one of those companies that would lead the way. We haven't seen that yet. He in fact called Liberation Day Massacre Day, but he does still believe there is a very large probability that we will get a de-escalation soon. But unfortunately, from what we're seeing at the moment, whether it's a negotiating tactic or not, this is not something that at the moment in time looks very plausible. And we have very famous super investor Bill Ackman, who actually goes on to accuse the Secretary of Commerce, Howard Lutnick, that he is ultimately indifferent to the stock market and the economy, whether it crashes or not, because his position is longing bonds and actually profits when the economy collapses, and therefore there could be a very large conflict of interest. And he goes on to say it is an irreconcilable conflict of interest. Now he did just earlier today go on to apologize for this statement, but what makes it very interesting to note is that for those that like to look at data points, maybe a bit of humor, maybe a bit of seriousness, but over the last few drops that we have seen going back to around 2019, it has typically been the bottom where Bill Ackman does come and have a bit of aggression, and that is something we are starting to see. Perhaps maybe he will come on CNBC like he did for the COVID drop, and maybe then it could be the ultimate bottom. Again, nobody truly knows, But also we have to understand Bill Ackman and his own portfolio, his own motivations. In fact, just some of the most recent purchases to his portfolio, and remember he does hold more than $12 billion, but one of his most recent additions, Nike, in fact, is down just 1/4 of its value, negative 26% over the last 30 days, and does now trade towards the lower end, if not pretty much at its 52-week low, something we could see at the market open. And one of his most recent purchases, in fact, at the beginning of this year, it was Uber Technologies, which is down around 11% just over the last 30 days, and who knows, again, could be sitting at its 52-week low upon the market open. So there is also reasons why we have investors or analysts say one thing or another. We always need to keep our wits about us, have our own due diligence before deciding to buy, sell, or even hold. And I also want to make one thing clear: you will see a lot of articles over the last few weeks, over the upcoming days, that Warren Buffett saw this sell-off coming. He has a crystal ball. He has been hoarding cash for a moment just like this. But we want to say this is definitely not true. Firstly, there is no crystal ball. And secondly, we have to point to the most recent large drop, which was the COVID 2020 pandemic. And Warren Buffett, if he did have a crystal ball, if he was in fact hoarding cash for a moment like this, why did we not see that with COVID? Well, in fact, we can see that is something he didn't do. He didn't, in fact, go and spend vast amounts of money on companies during that large drop that we saw. The S&P was down significantly, and that's because he says he didn't view this outcome in terms of a turnaround as an utmost certainty, and in fact viewed the worst possible outcomes that could happen. And whilst he does like to make money, one of the most important things in his own strategy is that he does not lose money. That is pretty much an ethos that he stands by, and that as an investor overall, he is one that is fairly cautious. So just something we do want to make you aware: Warren Buffett, no crystal ball, and ultimately whether or not he buys right now, it was not part of some master plan. But we can highlight the fact he does hold a significant amount of cash. In fact, he held a significant amount too during the COVID era, but the main takeaway is he has been building up this cash position for quite some time. Now, we have been touching upon this over the last few days, but as the S&P does in fact start to drop, and quite significantly, many analysts, many big banks are cutting their predictions, and we can now see Wells Fargo and RBC have cut their targets to around 5,500 points. Quite a significant drop, around 11%, where previously they did actually see making some nice gains, nice momentum to the 6,200 point, and they're seeing the index to close around 6.5% by the end of the year. And they're also not the only ones. In fact, as we do believe over the upcoming days, we will start to see a lot more follow suit, and we have just today Evercore ISI, in fact, the latest firm on Wall Street to cut their target. They also see a lot of blood in the market, and they're pretty much saying they anticipate the S&P to close around 5,600 points, which is around 10% higher than the close on Friday. But again, we are seeing it drop now in the pre-market. You also have to understand that recession odds are now increasing. This is on a global scale. JP Morgan see this at a 60% chance, which translates to them believing it is more likely than not that we will see the recession, and they're not the only ones. And now, given that we are seeing the price of oil drop more and more, global recession is something that we could hear a lot of talk about over the next few days, as we have done in fact just over the last week. Now, all of this is clearly getting the Fed worried, and now we're starting to see what Donald Trump had been saying for quite some time. He was saying even before tariffs that he wanted the Fed to cut rates and cut them quickly, and you could argue he is now starting to force their hand. And we have some breaking news that they have in fact called an emergency meeting this morning at 11:30 a.m. So when we do hear a bit more about this, we may start to see a clearer picture of how many rate cuts are anticipated. But at the moment, traders are now forecasting 5 cuts in 2025. Now, there is no harm in keeping up with the news on a day-to-day basis, but we would typically say to block out the noise, focus on your investments, do your own due diligence, especially if you are long-term investors. If you just look at history, it will always tell you it is impossible to time the market. It is more about timing the market. If you'd been invested in all of the days in the S&P 500, you would have had the largest gains than even if you would have missed 10 of the best days. And an interesting fact to note is that 7 of the 10 best days have taken place in bear markets. In 2020, the second best day happened immediately after the second worst day, and that if you miss 60 of the best days in the market, your investment returns would be 93% lower. Now, these are things always to consider, but we are long-term investors, and therefore we are looking at this 10, 15, 20 years out. If we believe the market is going to be higher during that period, then we will start to add dollar cost average in, whatever the strategy is, because ultimately these day-to-day, week-to-week fluctuations shouldn't really throw you off your long-term strategy. And it's also worth noting out that bull markets typically last longer than bear markets. In fact, the average bull period is 6 years and 1 month, with the average bear market around 1 year and 2 months, and you can always use this as a good opportunity to buy high quality stocks at incredibly attractive prices, something that we believe is ultimately the best strategy in moments like this. But again, as always, it is important to understand what your strategy is as an investor. Are you a long-term investor? Are you someone who is looking only 2 to 3 years? Or maybe in fact you are looking at this from a completely different view. So our strategy is going to be looking at high quality companies and adding to them at very attractive levels, and we believe there are a ton of options in the market right now, ones that we have covered extensively. As we said at the beginning of the episode, Nvidia sitting below the $90 mark. When the markets open, in fact, that will be pretty much towards the lower end of the 52-week range, maybe something you didn't see coming just over the last few months. Over the last year, though, it is still up around 10%. Over the last 10, if you do zoom out, massive outperformance of the S&P, and both Wall Street and Seeking Alpha do believe it is still a buy. Wall Street, in fact, call this a strong buy. And why we're saying it looks incredibly attractive, well, the valuation right now sits at 21 on a forward P. That is significantly lower than 42.9, making it incredibly attractive, severely undervalued. And yes, you could argue perhaps when you look at the P to E, the earnings, in fact, could be lower, but that is why we always use a margin of safety when we come to our valuation. Again, we can show you that, and it is also worth highlighting on this model where the blue tunnel is the expected fair price, the disparity between where Nvidia sits right now and the lower end of the fair price is at the maximum, giving this severe undervaluation signals as well. And as we have now showed you on countless episodes, our intrinsic value at our lowest, most conservative estimate gives $115, which as you can see is a growth rate moving forwards of 15%. We would typically use the median rate of 20%, so you're still getting upside right now at the 30%. This is if you believe they can grow their future free cash flows at 15% year on year over the longer term, when over both the last 5 and the last 10 years, they have grown it at a triple digit rate. Now with that 15%, but we can also quickly show you at the 20% for full transparency, 162 indicating 82% upside, and at 25%, 227 indicating 155. That is more than a double from the current price, and you can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Nvidia or any others. But as we said, even at the lowest rate, you are still getting a margin of safety, where we would typically use 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. And then we keep going till it's near the current trading price, and what we're effectively saying is, not at the 25% level just yet, but you're getting at least 20% margin of safety on our lowest conservative estimate, with Wall Street themselves giving this still a $170 price target, 99% upside, pretty much telling you right now Wall Street see Nvidia at twice the price over the next year. But as always, give us your thoughts. We understand margin of safety may need to be higher. In fact, the growth estimate may need to be lower just to take in consideration the earnings drop. But these are all things you need to factor in, need to consider as an investor, as they are fairly subjective. Now, before we move to the next one, just to let you know, we have just minutes ago released our latest free weekly article where we run through a couple of stocks we are adding in our portfolio. As always, you can click below, sign up and read for free, where every week we cover severely undervalued stocks as well as what's going on in the market, and you'll also be able to grab a copy of 35 severely undervalued stocks for the month, lots of information for each one, the upside that Wall Street themselves see over the next year, and a spreadsheet of 97 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, sign up, and you can read straight away. Other high quality stocks are ones like Alphabet. Again, we have spoken about this extensively, down around 2% in the pre-market, down in fact over the last year, but still over the last 10, outperformance of the S&P, trading at its 52-week low, maybe something you didn't think you would hear for the company, with a double buy from Seeking Alpha and Wall Street. Again, both of them very near to the 4.5 to flip it into a strong buy. And we can also see at the lowest forward valuation over the last 5 years, something we also noted for Nvidia, well below the 5-year average of 22.3. Again, severe undervaluations right across the board. And that is the exact same conclusion when we take a look at this model. Disparity between the two is pretty much at the highest it has been at least over the last year. And again, at our most conservative estimation at $197, you are getting a very large margin of safety. We have the growth rate at 10%. Again, you can see 10, 12, 14, the upside that you would get with each different level. And given this, and at the 10% MOS, still above at 177. And as we keep on going, you can in fact see you are pretty much getting not 30% just yet, but somewhere between 25 to 30 at the lowest estimation, with Wall Street seeing 54% upside, $220 price target. But give us your thoughts about these stocks, whether you're buying, whether you're selling, whether you're holding, or whatever your strategy is for today. We then move on to Taiwan Semiconductors, one that's been hammered in the pre-market, down more than 8%, still up over the last year 5%, still outperforming the S&P over the last 10. It will pretty much be at a 52-week low upon market open, a triple strong buy across the board, incredibly rare to see, probably the only company we have seen on the channel so far that does hold those three ratings. And again, forward P sitting at 16.1, significantly lower than the 5-year at 22.1. And again, on this model, we do get disparity. It is lower than the bottom end, but also the expected price is increasing, which is great to see, meaning the company is getting stronger on all accounts, thereby giving it another severe undervaluation signal. And our intrinsic value at $236 will give this an incredible margin of safety, but as always, investors will want quite a significant amount given the geopolitical issues, the tensions, and in fact, adding on this trade war, you aren't getting 45% just yet, but you are pretty much getting between 40 to 45, with Wall Street seeing an astronomical 80% upside, their price target $245. We also have Amazon, which is down nearly another 3% in the pre-market, down in fact now over the last year. Over the last 10, still outperforming, will probably open near the 52-week low. A double strong buy, not far off yet from getting that triple strong buy to be in line with Taiwan Semiconductors, and it has a forward valuation around the 26, 27 in terms of a forward P, with our lower level coming to an intrinsic price of $230 at the 20% growth rate. Now for those that do want to see at a 15, so even lower, it isn't that far off, so baked into the price is near a 15% growth rate to the free cash flow, but at our level of 20%, you are still getting a margin of safety. In fact, quite a significant one, like all of the stocks that we are running through today. Not 30% just yet, you are getting at least 25%. Wall Street, incredible upside at 60%, their price target $268. We then move on to Meta Platforms, one that is down around 2% in the pre-market, down 1% over the last year. Outperformance again over the last 10, trading near the 52-week low. We get a strong buy from Wall Street and a buy from Seeking Alpha. Again, trading lower than the 5-year average, and now a forward P around the 19 to 20 mark, could go down to 18, 19 once the market has opened. And we also get, for the first time on this model, in fact, severe undervaluation as it is outside of that blue tunnel, and the first time noted over the last year. So severe undervaluation could be on the cards for Meta Platforms. And our lowest intrinsic value at $699 is derived by using a growth rate of 10%, one that you could believe is fairly reasonable for the company. Over the last 10 years, 34% year on year, just in the most recent year, 23%. And with that, you will again get a substantial margin of safety. At the 15% point, a buy around $600. At 20%, still a buy. And in today's episode, you are in fact getting near a 30% MOS at 490. Wall Street 764 in a year's time, upside of 55%. We then move on to the wide moat semiconductor ASML, down 2% in the pre-market, down 36% over the last year. Over the last 10, still outperforming the S&P by quite a considerable way, trading at its 52-week low with a double buy from both Seeking Alpha and Wall Street. And we see this trading at a forward P of 23, pretty much one of the lowest levels over the last 10 years. And again, severe undervaluation is on the cards, very large disparity, in fact the largest over the last 12 months, so definitely one to consider in the portfolio if you are looking for a semiconductor play. And again, at our lowest level, intrinsically $920, which when we do do take a look, is using the lowest growth rate of 12%, still upside of 54. If you would use what we typically do at the 14%, you're talking about a value of over $1,000, 76% upside. And if you're someone that believes, no, that is very impossible, it won't get there, that is their 52-week high. And as always, important to understand that sentiment does typically follow the price. When a company's share price is increasing, people will continue to talk about how great a company is. They'll start buying, but when the script reverses, so does in fact that same process. People start to worry about the company, they start to sell without really considering the underlying company. Now, if we take the lower rate, as we are doing on this channel, you are still getting a very significant MOS. Again, at 30%, a buy at 643. At 35, pretty much where we see this now. Wall Street 933 over the next year, 56% upside, and do give us your thoughts below. We then move on to Novo Nordisk, again a one we have covered extensively. Actually, unlike others, is pretty much flat in the pre-market, although it is down 50% over the last year, trading at its 52-week low with a double buy from Seeking Alpha as well as Wall Street, and it's trading at its lowest forward valuation over the last 5 years, 16, when the 5-year average sits at 30.4. The yield on offer is the highest over the last 5, 2.6, 5-year at 1.41, and again we can see significant disparity, one of the largest we have seen maybe other than Nvidia today, so a lot of undervaluation considerations to make. And in terms of our valuation, $87, when we take a look, we are using the low growth rate of 12%, which will give you significant margin of safety. At 10%, a buy at $78, and as we keep on in fact going, you are getting 30% at this level. Wall Street see this, 84% upside, $112 price target. And then finally we end on Bill Ackman's Uber, which is down 4% in the pre-market, down 14% over the last year. Over the last 5 years though, outperforming the S&P, up 149%, likely to be around the 52-week low upon market open. Strong buy from Quant, buy from Wall Street, although not far at all from a strong buy at 4.5. Buy from Seeking Alpha, and a valuation sitting around the 26 mark. Our intrinsic value is also $90, again using the lowest growth rate assumption consistent in the episode, sitting at $90, 43% upside. If you use what we believe to be more reasonable at 10%, well, 104, but again we want to keep it consistent. And as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Uber or any others. But as in fact we do keep on going, you are pretty much getting 30% MOS. Wall Street themselves see $92 over the next year, translating to 46% upside. Again, give us your thoughts about these stocks, give us your thoughts about your own strategy moving forwards, and in fact what you do believe of the current global economy. Don't forget, as always, sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our weekly buys and sells, and as always, have a great day. We'll see you all on the next one.